Okay, so it's about time to start for today's lecture. So any questions on the midterm or any inputs or feedback that you want to provide to me for the final, potentially? Or any comments?
What was the median score on the midterm?
The median, I didn't put that.
Or mean, anything. Give me some data. Come on.
Hold on. If you really want the median.
Sure, give me something. I mean,
Okay. If you want the median, hold on. Let me just get to the grading.
I want to know if I'm like the village idiot or I'm a genius,
I don't have that. Give me a minute. I can definitely do that. Performance. And while I'm doing so, any other questions?
Professor, for the final, are we going to have the same amount of questions and same amount of time, or is it going to be different?
So apparently, surprisingly, a lot of you actually finished the exam like before 3-hour time limit. So I think I'm going to give about the same amount of time for the final. So about 3 hours and 100 questions.
It was a lot, Professor.
It was a lot.
Yeah, I felt like I didn't have enough time to read the questions well in order to do them. Like I didn't have enough time. That's why I'm asking.
I see. I'll have to think and go ahead.
I myself finished on the dot. I think I clicked the last question right at the last second.
I think if it would be morning, it felt that we could have be at a higher speed, but I think because it's evening and it's like 3 hours and 100
when the brain is
yeah. No, I don't know. I mean, even with the coffee, kind of, I don't know, could be. But
and for my kids, I'm sorry, Victor, we have like families. Like I have kids here. They were banging in my door. It's not like we can't go to the office. We can't go to the library. So there's so many unexpected, and 2 minutes for each question. Like if you're sick, if like you can take a minute to breathe. So I think it was a lot of questions. I did well. I'm not going to complain, but again, I had my daughter and I have a lot of help. But what about single parents? Or
I see. I see your concern. Whoa, hold on.
And also, during the exam, I don't know if it was at the same time you added the other exam, but my exam crashed for a few minutes because of that.
Okay, so I mean, any inputs are very valuable to me. But I mean, according to the grade distribution, it's very much better than what I expected. But if 100 questions in 3 hours are just too much, I can definitely reduce the number of questions. But keep in mind that again, this is not how to put it, the absolute score or absolute grade for the final does not determine your final grade. It is a relative standing. So if the exam becomes easier for everybody, it can actually come back to you.
No, but Professor, it really is a lot of questions though, or not enough time. It's like, it really is a lot of questions. So like, I just ended up just going through all of the questions because of course, some of them are easier than others, but it's just like really a lot. They were great questions though, by the way. I love your course. It's awesome, but it's just way too many questions.
Okay,
like we're not asking to just like make it half of the questions. No, but just like 100 questions. It's a lot of questions.
Okay.
Like for 3 hours in the evening, it's tough because most of us, I guess, have full-time jobs and families and whatever it is. But it's just, yeah.
I'll take that into my consideration for the final. Hold on, I've been calculating the median for everybody. So the median for the midterm is 87. Okay, so again, 87 median, it's very good. Historically, the midterms for the financial accounting for introductory course is about 70, like mid-70s, but given that it's 87, everyone did a very good job. So, I mean, if the exam becomes easier, it'll be much tougher for you to get good grades. Hold on. So too many questions. Okay, I'm reading your chats. Exhausting. Okay, so I guess 100 questions are just too many. It's like 6 parts long, rush through 19 seconds to spare. Okay, so I'll take that into my consideration and definitely reduce the number of questions, okay?
Also, I don't know if anyone else felt it, but the questions seemed to have been like a bit uneven. Like some questions had a lot of parts you could put into it, so you had to take a lot more time to put into it.
Mhm.
There's other questions you could figure out in 2 seconds because just by reading and then clicking multiple choice, and the other ones were the writing ones. And
Yeah. I mean, again, I mean, this exam or this online format, because of its online format, it is an open book. You can definitely search through the internet to get the answers. So, I mean, I have to make the questions much challenging and difficult relative to historical classes. But again, median is 87. Everyone is doing really great job. And I was really surprised by that and happy with that. But again, the final grade, again, is the relative standing of yourself compared to others. So be mindful of the potential harmful or backfire if I could just give you really easy and just mundane questions, okay? Hold on, let me just read through the chats first. So Victoria says, is there a way to split the exam into 2 sections? Something is because going super fast. Okay, I guess it's related to 100 questions. So maybe I'll reduce the number of questions. So some just suggest 90 questions, 75. But again, the final is cumulative. So I cannot really make it to 50 questions. It's just not even possible. But I'll just think about between 75 and 100 questions, okay? Jason says, is there any extra credit opportunities? Unfortunately, no, every spots are filled already. You do have time for this, even if you do not have, okay.
Yeah,
Okay.
I was referring to your exam being an open book, so we can use internet and everything. You honestly, you don't have the time, and even if you wanted to use any other source, the only source you could use is your head. You know what I mean? And it's just like, we don't negotiate and just ask you like whatever. But honestly, like 100 is too many. Like maybe 80, 85, 90. Like it'll be great.
Okay.
I mean, we're not asking for easy questions. We just want to ask questions.
Again, even though this is an open book, access to the internet, my expectation for students is that you do the exam with your own understanding and based on your practice and understanding of the course materials, not just rely on the internet. But it's just one suggestion. I mean, if you're not really sure about one particular question, you can definitely go into the internet and get some help, extra help. Hold on. I think the questions were fair difficulty. Okay, just bit less question. Okay, so in terms of the difficulty, it was okay. Just the number of questions is the issue. Okay, anyone else? Okay, no more. Okay, so I'll definitely reduce the number of questions for the final, but be mindful of the fact that your grade, final letter grade, will be impacted by this. And then the difficulty of the questions will definitely increase, okay? Any other concerns?
Professor, I had one quick question. On Connect, are you able to see what you got wrong or?
Yeah, I make that available right after the exam.
Whoops, sorry, I didn't see that.
No problem.
I'll check that, thanks.
Yeah, you can definitely go back to the exam and then see which questions you got it correct or not, okay?
Gotcha, cool, thanks.
So before we get into chapter 7, just one student sent me an email to go over 2 questions in the midterm that she was not sure of. So I'll just cover those questions right now, okay? So this was one of the 100 questions in the midterm. So the company estimates uncollectible accounts expense using the percentage receivables method, expects it 0.5% of all accounts receivable was not collectible. The company reported accounts receivable and allowance for these amounts respectively. So that was last year, and during this year, the company made credit sales and collections were these amounts, and some amounts were written off. The question is asking the company's accounts receivable at the end of the year. So it's pretty much straightforward. So basically, you had, so December 31st, 2016, you are ending the year with accounts receivable amount of $471,000. That's given. And then during 2017, okay, the company made credit sales of $350,000. That's accounts receivable increase. Okay. And then the company collected money. So that means the accounts receivable decrease by $319,000. So what that means is that there is a decrease net amount of accounts receivable by $4,000. Okay. So what that means is that at the end of 2017, you're starting out with $471,000. During the year, you decrease accounts receivable by $4,000. So your accounts receivable at the end of the year becomes $467,000. Okay. Plus, during the year, the company also reports the write-off on accounts receivable right here. Okay. So you are going to also subtract $1,720. So that will lead to 400, let me do the math. So 5,280. Okay, so this is going to be the ending balance of the accounts receivable. So the answer is A right here. Okay, so I mean, it shouldn't be any problem with this. So again, the credit sales was this, you collected more amount. So you have a net decrease of accounts receivable by $4,000. And in addition to that, you are also writing off accounts receivable by $1,720. So you're going to subtract that amount again. So your ending balance becomes that. Okay. And then as a follow-up question right here, okay, same information, different questions. So the question is asking uncollectible accounts expense. So in other words, calculate the bad debt expense. Okay. So let me just do a T account for allowance.
Can you make the question larger? It's a little hard to see. I don't know if that's possible, but thank you. Yeah, well,
I can do that. Maybe that's whoa. Okay, better.
yes.
Okay, so let me just go up a little bit. So you have here allowance. Uh-oh. Let me. Okay, this is the best I can do. So you have an allowance T account. According to the information in the last year, you're reporting the ending balance of $1,650. Okay. Now, what we just calculated for the ending accounts receivable was this, 465,280. So you're going to multiply that by 0.005 because according to that information, 0.5% of the accounts receivables are not going to be collected. So if I use my calculator, so 465,280 times 0.005. So that's your ending balance should be 2326.4. Okay. Now you also have this write-off. Remember for the journal entry for the write-off is allowance debit and then accounts receivable by 1720. Okay, so during the year, you're reporting allowance of 1720, and then you have a bad debt expense right here. Okay, so if you do the math in this, you will get 2396. Okay, $2,396 of bad debt expense reported during the year. Okay. Whew. That's it. Any other questions before we get into chapter 7?
Is the final, does it include the second half or does it include everything?
It's a cumulative. So from chapter 1 to chapter 11, but more weights towards the later chapters, of course. Yeah. Yeah. I mean, since you guys want less number of questions, I'm now questioning whether to just focus on the later part. I'll think about it. I mean, final is like way later, right? But any other questions? Okay, so we'll get into chapter 7. Whew. Yeah, chapter 7, and we're gonna talk about long-term assets. So let me just do raw balance sheet again. So you have assets, liabilities, and shareholders' equity. Chapter 5 was related to accounts receivable. Okay, so percentage of accounts receivable method, aging method, and percentage of sales method. And we also talked about allowance. Okay, so the estimated amount of uncollectibles, that was chapter 5. Chapter 6 was inventory. Okay, remember? So how much amount to include for the purchase price for the inventory. We talked about the cost of goods sold. We talked about FIFO, LIFO, weighted average method. And we also talked about the lower of cost or market methods to evaluate whether we will going to mark the value down for the inventory or not, depending on the situation. So that was chapter 6, mostly focusing on the current assets. From chapter 7, we're going to focus on long-term assets. Okay, so we're going to talk about plants, factories, equipment, vehicles, fixtures, and some other intangible assets that we're going to talk about. Okay, so that's the focus of chapter 7. Whew. So these are some of the examples that are reported in the balance sheet under long-term assets. So in a broad category, we divided these long-term assets into tangible assets and intangible assets. And just the name as it is, so tangible is a physical substance, so something that you can really touch or something that you can physically see. But whereas for intangible assets, it's something that you cannot really see or something that does not have a physical substance to it. Okay, so I mean, land is one example of tangible assets. Also, we have buildings, equipments, natural resources. We don't have much focus on this natural resources, but if you go to advanced accounting course, you will definitely learn natural resources that will drive you nuts, but that's for later semester. So for this course, we're going to focus on these 4. So land improvements, buildings, equipment, factories, and vehicles. For intangible assets, we have patents, trademarks, copyrights, franchises, and goodwill. Again, that's just some of the examples that are reported under intangible assets. Okay, so I mean, in today's industry, we can mostly talk about, I can talk about some companies. So let's say, for example, Dunkin' Donuts, or my favorite is Starbucks. Okay, so these are basically tangible asset intensive. Okay, so their revenue stream or their revenue or sales come from mostly using these tangible assets. So they have a store for the store for serving customers. They have these espresso machines and all sort of the variety of coffee packs and everything to produce revenues. Okay, whereas for companies like Google, they mostly rely on this intangible assets. So their revenue stream depends mostly on the services. So Google search and advertising and this intellectual properties. Those are the things that drive the revenue stream for companies like Google or Apple company as well. Okay, so I mean, different types of companies rely on different I guess portfolio or structure of the assets that will produce the revenue. Okay. I mean, but again, the focus of the course is to make sure that you know how to write journal entries and understand the transactions related to each examples that are laid out right here. So just one example here, this Daeun restaurants balance sheet. Looking at this, they are so you have a current asset section that are reporting accounts receivables and inventories, but also they have long-term assets, property, plant, and equipment, and tangible assets of these amounts. Again, these are just, I mean, they are real examples, but I just want to bring up the real examples. So let's take a look at my favorite company right now is Tesla. So again, the financial statements can be easily found under item 8 right here. So here, current assets, we talked about this prior to midterm. Here, you have solar energy systems and property, plant and equipment, operating lease, intangible assets, goodwill. Those are the long-term assets that are some of the examples that are reported under Tesla. Let me just bring up Apple company. So they don't really have many categories of long-term assets. What about Apple company? Item 8, balance sheet. So they have marketable securities. So basically companies also can invest in other companies to make profits. So those are reported under marketable securities. They also have property, plant, and equipment and non-current assets. So depending on the company situation or depending on the structure of the company, Apple company does not have many categories reported under long-term assets. Tesla has more categories relative to Apple company, but the basic idea is that companies should report the long-term assets with the respective amounts. Okay. One thing that I want to mention, So going forward, I'm going to talk about 3 major things related to long-term assets. So in chapter 6, when we talked about inventory, okay, we focused on the acquisition of the inventory. So remember, in terms of the purchase price, okay, purchase price, what cost to include or what cost is not to include for the purchase price. So we're gonna take the similar approach in the long-term assets. So I'm going to give you a lot of examples with respect to the purchase of the long-term assets and what to include or what not to include for the purchase price of long-term assets. Also, we're gonna talk about expenses, okay? So after you purchase long-term assets, you are going to report related expenses periodically as you're using these long-term assets. For example, I mean, in the real world, let's say you buy, so iPhone U. So iPhone 12 is out. So let's say you buy an iPhone 12 right now at, I don't even know the price, $1,200. If you are going to sell this new iPhone 12 to another customer or another person, you're not going to sell it at $1,200. You're going to reduce the price, for example, $1,100 or $1,000, because just because you're holding that iPhone 12, the value of that asset decreases. So in terms of decrease in the value of the assets, the companies will going to report the expenses related to holding that asset while generating the revenues. Okay, so that's the number 2 approach. And lastly, we're going to talk about gain or loss on sale of long-term assets. So sometimes companies decide to sell it to a third party of your assets, and sometimes you can make money out of it, or sometimes you lose money depending on at how much you're selling that assets. So when there is a gain or loss on that transaction, we're going to also talk about how to record that journal entry. Okay, so these are the 3 approaches that we're going to talk about throughout chapter 7. Okay. So the first objective is to identify the major types of property, plant and equipment, and then evaluate or determine the purchase price for each long-term assets. Okay. So obviously, when you're purchasing an asset, there is going to be the original cost or the purchase price of that asset. And that's pretty much given in the information. You can definitely look at the invoice, or you can definitely look at the contract of the purchase, and that this invoice or contract will include information related to the original cost of the asset. But in addition to it, there are going to be extra expenditures necessary to get the asset ready for the use. So what that means is that, for example, there are going to be, let's say if you're purchasing a building, okay? If you're purchasing a building, there are going to be some attorney fees for registering that building, real estate commissions, title fees, and some insurance fees that you're going to pay for that building. So any necessary expenditures that makes this asset ready for use or makes this asset designed to function as you originally intended to, those all expenditures will be going to be included in the purchase price of the asset. So similar to the shipping cost that we talked about in what was in chapter 6. Okay, so when you purchase inventory, the shipping cost will be included in your purchase price, and then some sales tax, for example, will be included in the purchase price of the assets. Similar idea here. Any extra expenditures that you're spending to obtain that asset, make the asset usable, to make the asset designed to do what I intended to, those expenditures will be included in your purchase price of the asset. Okay. Any questions before we move on? Okay, so one terminology that I want to talk about today is this capitalize, okay, or capitalization. So, I mean, we are using this term expenditures, so that may look like an expense. So, like a salaries expense or supplies expense that we used to talk about in chapter 3 or 4. But those expenses are actually converted to assets because they are included in the purchase price of the assets. So when we convert those expenses to assets, we use this term capitalized to explain that. So in other words, those expenditures will be capitalized into the asset. Those are the statement or expressions or the language that we use in accounting field to convert the expenditures to assets. Okay, something that you should be familiar with going forward when we talk about chapter 7, dealing with long-term assets. Okay. So let's start with land. So land is pretty much easy. So it includes the cost of the land, pretty much straightforward. It's the price is given in invoice or contract. Also, you're going to include all expenditures necessary to get the land ready for the intended use. So for example, you are going to include the real estate commissions and fees that you're paying to obtain the land. Also, as a buyer, if the land has some back property taxes, the buyer also have to be responsible for that back property taxes, and that tax should be included in the purchase price of the land. Okay. Also, to make the land ready for its intended use, there are going to be some costs related to clearing, filling, or leveling the land. So those costs will be included in the purchase price of the land. One thing to note with respect to the purchase of the land, sometimes companies also receive cash from selling some of these salvaged building materials. So I don't know whether I can draw well. So let's say this is the land. And then this is the old building that needs to be broken down. Some of the materials can be sold. Okay, so there are some steels or aluminums all those raw materials you can basically sell to, I forgot the term, but
Salvage.
yeah, there you go. So basically these raw materials can be sold for some extra cash. So when the buyer of the land receive cash from selling those salvage materials, those costs will reduce the purchase price of the land. Okay, this is something that you should be mindful of and be careful with when you're dealing with questions. Okay, because basically by just receiving the cash, you are reducing the purchase price of the land. Okay, that's the basic idea. Okay, but land is pretty much easy, right? So again, the point is, any extra dollar amounts that you're paying to obtain the land or to obtain that long-term asset will be included in the purchase price of the asset. That's the basic idea. Okay. So for example, here in the contract, the contract will say the price of the land is $500,000. Very good. So you're going to include commission fees, back property taxes, title insurance, and those costs will be included. And there are going to be some costs related to removing existing buildings. So in order to remove the building, you're going to spend some money, but at the same time, you can also sell some of the materials that compose the structure. So by selling some of the materials, you receive some cash, and that will reduce the purchase price of the land. So at the end of the day, your dollar amount that you're going to report in your balance sheet is going to be $590,000, given this example, instead of this $500. Okay, so again, so the key is this: any expenditures you're spending on to make the land ready for use, it will be included in your purchase price. Okay, any questions? Okay, now another thing you should be careful with is land improvements. Okay, so when you buy a land, there are going to be several purposes with respect to why you want to purchase the land. You can also basically make parking lots, sidewalks, driveways, all sort of these examples given here, lighting systems. So these are the land improvements to make your value of the land improve or increase. Okay, so the thing is, this land improvements will not going to be included in the land account items. Okay, so these are separate line items to report in the balance sheet. So what I mean is, in the balance sheet, you have a land right here, and you will have a different line item called land improvements. And the reason why we do not combine these two is the fact that these two have a different life cycle or life, or let me say, different useful life. Okay, I mean, land is basically infinite. As long as you have that land, you can use the land forever, unless there is an earthquake or some natural disasters that basically remove the land. That land will stay the same for many years to come, right? But when it comes to parking lots or driveways, they have a finite number of years for useful life. I mean, of course, parking lots can stay for 10 years or 20 years as long as it is intact, but definitely the useful life for these improvements is much less than the land itself. And that's why we report land and land improvements separately. Again, because of the different useful life factor related to them. Okay. Yeah, that's pretty much the land and land improvements. Let's talk about buildings. So when we talk about buildings, companies can buy a building, or sometimes companies can build the new building itself. But again, the idea is if the company is buying or purchasing a building, the company will report not only the original purchase price of the building, but the company will also include or add the costs related to the purchase of the building. And the example is, again, commissions and legal fees and titles. Also, if some remodeling costs will also be included in the cost in the purchase price of the building. Okay, so again, the key is here. So, and when you're purchasing a long-term assets, you are going to include any cost to make that asset ready for your original intended use will be included in the purchase price. Okay, now, in case where the company decides to build a new or construct a new building rather than just purchasing it, there's a whole different accounting issues related to it. And you are going to learn that in the next intermediate accounting course, and that will again drive you crazy. We talk about, let's say, if the construction makes 10% progress or 50% progress, by how much dollar amount you're going to report in your balance sheet. That will require lots of judgments, assumptions, and evaluations. So again, that part is for the intermediate accounting course. So for this introductory accounting course, we're going to focus on the first part where the company just buys or the purchases the building itself rather than constructing it. Okay. Equipment. So, I mean, equipment, any machinery, vehicles, or furnitures that have a long-term life cycle, or something that helps manufacturing, inventory, for example, those are going to report under equipment. Okay, so again, sales tax, shipping, assembly costs, those costs will be included in the purchase price of the equipment. Okay. Now, with related to equipment, let's say, for example, machinery, there are going to be some periodic maintenance fees or like an oil change or something like a minimal small maintenance cost will not going to be included in the purchase price. They are just expensed as incurred. And later on, I'm going to talk about what cost is included in the purchase price and what cost is just simply reported under expenses. And that will require your judgment and your evaluation with respect to whether that cost will help the asset live longer or improve the efficiency of the asset, or it's just simply helping this asset to continue to produce inventory, for example. But again, I'm going to talk about that later on. Okay. Any questions so far? Okay. So here, given this equipment example, purchase price is given, and you're also going to include sales tax into your purchase price, transportation, shipping, insurance, and installation fees are going to be also included in your purchase price. So this $91,000 is the dollar amount that you are going to report in the balance sheet under equipment. Okay, so your job for the final, now it's the final, let's talk about final. So your job is to determine which cost is to be included in the purchase price and which cost is not included in the purchase price. And depending on that dollar amount, you are going to also report the different number of depreciations that we're about to talk about coming forward. Okay. So sometimes there are cases where the company makes a basket purchases. So when we talk about basket purchases, basically the company is buying more than just one asset at the same time for a discount. For example, the company can buy a building, land, and equipment all together for a discount. Okay, so let's say land is $500,000, building is $200,000, and equipment is $300,000. So in total, it could be $1 trillion. But since the company is buying all together, the company is given a discount and $900. So if this is the case, by how much you should report for these three assets separately, I'm going to talk about this soon. Okay. So basically the rule that we're going to use is the relative fair values, okay? So here, for example, when the company purchases these 3 assets for $900,000, okay? And let's say the fair value for these assets are land is 200,000, building is 700,000, equipment is 100,000. So in total, the sum of the fair value of 3 assets, $1 million. So given this, by how much the company reports land, building, and equipment in dollar amounts is the question that we're going to investigate on. Okay. So
I'm sorry. Why is it you're getting this? It's like you're getting some bundle discount.
Yes, the bundle. I mean, in chapter 4, I guess we talked about the bundle purchase for inventories, right? I mean, if the customer decides to purchase in large bulk, they get discounts. So in this case, similar idea applies. So if you buy all 3 together, the seller decides to give them a discount.
I mean, it's a funny context because I've never heard of such a thing in real estate.
Well,
like,
that happens. That's why that happens. That's why we are covering in this
okay.
course. Yeah.
Sure.
Yeah. So we're going to talk about the ratio here. So the total is $1 million. The fair value for these assets is 200, 700, and 100. So in terms of the ratio, the land pretty much accounts for 20%, building accounts for 70%, equipment accounts for 10%. Okay, so you're going to multiply these ratios to the purchase price in order to determine the dollar amounts that you're going to report in the balance sheet. Okay, so even though the fair value is $200,000, what you're going to report in the balance sheet is $180 because you are taking this 20% of the purchase price. Okay, for building, you're only going to report $630,000 because in terms of the ratio, the building accounts for 70%. So you're going to multiply the 70% to the purchase price of $900,000. So that will result in $630. Okay, same idea applies here. Purchase price is 900. Equipment stands for 10%. So you're going to multiply that ratio to get the $90,000. So in total, again, you should get the same amount of $900,000 that equals to the purchase price. Okay, so that's the basic idea of the basket purchase. Okay. Any questions on this? Okay, so very good. So a company makes a basket purchase of these 3 assets. The fair values are these respectively. The purchase price is $210,000. How much should be recorded to the land account? So let me just briefly go over them. Okay, so you have land, you have a building, and then equipment. Okay, the fair values are 70, 150, and 30. So in total, that's $250,000 of fair values, but the purchase price is 210. You're paying less than the purchase price. So in terms of the ratio, the land is 70 over 250. I'm not going to go into that. So let me just do the calculator.
58.8.
58.8?
Yes.
Okay. So 58.8. I'm going to trust your word. So you're going to multiply the 58.8 times this purchase price to get the fair value. Oh, yeah, the number, which is 58,800. Okay. Oh, it's not 50, it's 28. Okay. 28.
What? No, the dollar value is 58.8.
Let me just do the math. So 70 over 250. So that's 28%.
Yeah, multiplied by 250.
Yes, 250. Oh, you mean, oh, okay. You mean the dollar amount.
Yes.
Yeah. So that's how much, that's the way you determine the dollar amount that you're going to report in the balance sheet for each assets in the case of the basket purchase. Okay. So we talked about this physical assets, physical long-term assets. Let's move on to the intangible assets. Intangible assets, the examples we talked about is patents, copyrights, trademarks, franchises, and goodwill. So again, these intangible assets can be purchased. Okay, so patents, you can purchase patents, copyrights, trademarks, and not necessarily the purchase, but I mean, imagine that you can purchase copyrights and trademarks. Those amount, the dollar amounts, they are basically written in the contracts will be the price that you're going to report in the balance sheet. But most of the cases, these intangible assets are developed internally. So the question is by how much you're going to report these intangible assets in the balance sheet. And we're going to talk about them, okay? But the idea is basically the same. So you're going to record the original cost or the purchase price plus all other costs necessary to get the asset ready. Again, the key idea is this. Whenever you're paying for the assets or any expenditures that you're paying to get the asset ready for use, you're going to include those expenses into the purchase price, okay? But in case of in case where the company develops these patents or trademarks or franchises, you are going to expense most of the cost in the income statement. So what that means is, let's talk about patents. Okay, if the company decides to purchase patent from another company, the dollar amount that you're paying will be the dollar amount will be reported on the balance sheet. Okay, very easy. But in case the company decides to develop a new technology and then register them to a patent office, those costs will not going to be reported in the balance sheet. Okay. Instead, you are going to expense most of the cost in the income statement. Okay, and that's the key difference between the purchase of the intangible assets versus developing internally in-house within the company. And if you're asking me why you're not capitalizing those costs in the and then reporting the balance sheet, it's because most of the I call it R&D, okay, research and development cost, they fail. Okay, I mean, some companies succeed in developing this new technology or innovations and then register it to the patent office. But the reality is most of the R&D expenses, they just fail to come to fruition, basically. So because of this high uncertainty, the accounting professionals came together and then decided that unless these R&D expenses are definitely going to succeed, we are going to just mostly report and expense those costs and then report in the income statement rather than capitalizing and then make it in the balance sheet items. Okay, but that's pretty much the idea with respect to these intangible assets.
Wait, but then Professor, if they don't fail, what do they list the asset as when they create it?
If it fails, it's not an asset. So again, the definition of an asset is something that produces benefits, okay? Something that makes revenue. If the R&D expenses, if the R&D fails, there's no benefit, right? So we are just simply going to expense most of the R&D costs.
Yeah, but I'm asking if it succeeds.
Oh, if it succeeds. So that determines, so if it succeeds, okay, then, or let me just, how should I put it? So let's say if the company estimates that there is a 70% probability that this R&D will succeed. Or let's say if the company expects that 90% of the expecting about 90% that this R&D will succeed, depending on the percentage and depending on the assumptions and judgment, some of the cost will start to be capitalized, and then converted to assets. Okay, but again, this judgment depends on the circumstances, depends on the situation, depends on the company, depends on the lawyers interpreting these, the process. It really differs from one company to another company. But again, if there is a high probability that this R&D succeeds, then the cost will be capitalized and then reported in the balance sheet. Okay, but prior to that process, basically all of the R&D expense, R&D costs will be expensed and reported in the income statement. Okay. Any other questions? Okay. Okay. One thing that I also want to mention is that under US GAAP, okay, you can think of it as R&D costs. Costs are expensed. Okay, basically all, with a little double quotation here. But if we talk about IFRS, the International Accounting Standards, research costs are expensed in general, whereas development costs are capitalized. Again, it's the probability. So basically by researching certain new technology, you don't have a high certainty or probability that this research will succeed. But in terms of development, that basically means you're past this is the initial stage and you're actually developing into something tangible. So under IFRS, if the cost is reported during the development stage, some of the costs will be capitalized and reported in the balance sheet. But again, that requires an interpretation and judgment of the accounting professionals working in the company, as well as lawyers working in the company. But the basic judgment or the criteria is that whether this cost will come to fruition into success. That's basically the idea. Okay. Whew, yes. And then patents. Okay, so patent usually lasts for 20 years. If the company purchases the patents, you can capitalize the purchase price. In other words, you can report it in the balance sheet, plus any additional costs related to filing fees and legal fees. Those are going to be included in the purchase price. If the company decides to develop it internally, you're not going to, these research and development costs are expensed because you don't have a high probability of a success, but this legal and filing fees. So the fact that the company is actually paying this legal and filing fees, that means that this technology or this new and innovation is almost close to fruition and almost close to the success. So that cost, these legal and filing fees, will be capitalized and included and reported in the balance sheet. Okay, but again, this research and development costs most of the time will be expensed and reported under income statement. Okay, copyrights, longer years, 70 years. Again, the idea is if you're purchasing the copyrights, you're going to report the exact dollar amount in the balance sheet, and then plus any extra costs related to the purchase of the copyrights. Okay. Trademark. So I'm not going to go into the detail, but it just the key here is that whatever you're paying for, the intangible or even tangible assets, to make that asset useful for your original intended use, you're going to add everything into your purchase price. That's the key idea. Okay. And your job for final exam is to determine which cost is to include and which cost is not to include in the purchase price. Okay. Franchise and goodwill. One thing that's interesting with respect to this goodwill is that you cannot really purchase the goodwill. Goodwill, the line item reported in the balance sheet, always arises when the one company purchases another company. So let me just give you an example. So here you have a balance sheet, assets and liabilities. Let's say total assets is $150,000 and total liability is $100,000. Just an example here. So what that means is that this company has a net value or net assets of $50,000. Okay, so assets are the benefits, liabilities are the obligations. So what that means is that after paying off or after completing all the obligations that you have currently, which is $100,000. So when you complete these all obligations, at the end of the day, you have an extra $50,000 in your hand that are disposable, basically. Okay, that's what this net asset, $50,000, is indicates. So let's say this is company A. If company B decides to purchase the company A at $60,000, so what that means is that this company B is paying more than what company A is valued at. Okay, and the reason why the company B decides to pay extra $10,000 is because of the goodwill. Okay, because of the synergies, because of the reputation of company A, or any other reasons. There are going to be reasons as to why the company B decides to pay extra $10,000 on top of the book value of the company A, $50,000. And that extra $10,000 is the goodwill dollar amount that is going to be reported in the balance sheet. Okay, so you don't purchase goodwills, you don't internally develop goodwill. This goodwill always arises when one company purchases another company. Okay, that's the only occasion where the company reports its goodwill. Okay, any questions? Good. Okay, so this is an example here. So this is the buyer company. Allied Food acquires Ritz Produce for $36 million. So this is the purchase price, $36 million. And given this information, the acquiree, okay, acquiring company has identifiable assets of $50 million. The acquiree's liabilities total at $24 million. So what that means is the net asset or net value of the company is $26 million here. So given this 26 net asset amount, the company or the acquirer company is paying $10 million extra to purchase the company. Okay, so this $10 million of extra dollar amounts will be reported under goodwill in the balance sheet. Okay, so again, goodwill is not purchased, goodwill is not internally developed. That always occurs when one company purchases another company. Okay. Yes. Which of the following is an exclusive right to manufacture? So I mean, this is not important. I mean, as long as you know what trademark is, patent is, copyright is, goodwill is, you are in pretty much good shape. Okay. I don't really care about the definition of these different types of intangible assets. Okay. So so far we talked about the acquisition. Acquisition. What acquisition? What amount to include? What amount not to include? And then in the purchase price. Going forward, let's talk about expenditures or expenses. Okay, and the focus is here is depreciation. Depreciation. Okay. So when you have these long-term assets, especially on tangible physical assets such as machinery, vehicles, or factory, there are going to be repairs, there are going to be maintenance, there are going to be additions and improvements and litigation costs related to these long-term assets. And the question is, when do you expense those costs, or when do you capitalize those expenses? And that requires your judgment. Okay, so you are going to expense some of these costs when they only benefit this current period's operation. Okay, but you are going to capitalize some of these costs if they benefit future periods. Okay, so the criteria here is the timing of the benefit, whether that benefit will apply in the current period or in the future periods as well. Okay, those are the key criteria that are used to determine whether these costs should be expensed or capitalized. And I will talk about some of the examples here. So here, repairs and maintenance. Let's talk about some examples here. So let's say you own a vehicle, and then if you own a vehicle at every, for example, 3,000 miles, you make oil changes, and periodically you do some maintenance with respect to vehicles, and that repairs will be expensed. Because of the oil change, you are going to only benefit the future, not the future, current period, and that should, because of the fact that it only benefits the current period, you are going to expense those repairs. So those basic repairs are going to be expensed. But if, let's say, you are changing the engine of the vehicle, that engine will also benefit the future period. So if the repair and maintenance makes or gives a future benefit, you are going to capitalize the cost. Okay, so again, that determination requires your judgment as an accountant in the company. Okay, additions, because it is an addition, you are going to capitalize the cost. So for example, you have a truck here, ugly truck here. Let's say you are adding this refrigerator on top of the truck. So this addition will definitely be capitalized. Okay, good. That will give the benefit in the future period as well. So this addition will be capitalized. Improvements will be also capitalized. And then for legal fees, I'm going to talk about them later on. But most of the cases, it will be capitalized with some exceptions. Okay. Again, the criteria to determine whether you are expensing those costs or capitalizing costs depends on the materiality. If the cost materially improves the operation of the asset, you are going to capitalize it. If it is not material, you're just only going to expense it. Okay, that's the basic idea. Let's say you are running Apple company. You're running Apple, and then the company decides to purchase computers for employees. Okay. The fact that the company is purchasing computers for employees, that will benefit current period for employees, but it will also benefit future period as well. Does that mean the company will capitalize these computers? Depending on the materiality. If, let's say, the company decides to purchase 1,000 computers, okay? that will definitely be capitalized, because in terms of the dollar amount, it's a huge dollar amount, and that will also produce benefits in the future period. That will definitely be capitalized. But if the company decides to purchase just one computer for one employee, there's no point of capitalizing the cost. It's just, yeah, it's just a small dollar amount. So in that case, the company would just expense it. Okay, so again, depending on the materiality of the purchase, the company has a set of criteria to determine whether that cost should be expensed or capitalized, depending on the situation. I mean, here the book talks about this this $1,000 as the criteria whether we're not to expense it or capitalize it, but it's not that the rule of thumb. Each different company has different level of expenditures to determine whether that cost should be included or not. But again, the idea is this materiality. Okay. Any questions? Okay. I cannot really see this. I'll check on this. I don't know why we're not seeing fonts here. So let's talk about cost allocation. So in this section, we're going to talk about depreciation and different method of depreciation for these long-term physical assets. So when we talk about depreciation, it basically means there is a decrease in the value of an asset. So what that means is if you buy a truck or vehicle in year one, the value of the vehicle in year two or year three will decrease, right? So for example, you have a new Mercedes-Benz GLB at $50,000. Okay, in year one, the value of the vehicle in year two will decrease by, for example, $40,000. And year three, the value will again decrease to $30,000. So by just holding that asset, the value of that long-term asset will decrease. And the question is, by how much? The company decrease the value of an asset. That's the key part here. And there are different methods, okay? Methods to determine the dollar value amount for that decrease, okay? And we're going to learn the different methods. So remember, we learned percentage of accounts receivable method, we learned aging method, we learned percentage sales method in chapter 5 with respect to the uncollectibles. So same idea here. In terms of the depreciation of the assets, there are different methods to calculate the dollar amount for the depreciation. Okay. Now, we have two different definitions. So dictionary definition or accounting definition. So dictionary definition basically is a decrease in value of an asset. So what that means, let's say you have a year one, year two, year three. I mean, the best way or the realistic way of calculating the decrease in the value is that you measure the fair value of an asset at every period. Okay, so let's say in year one, let's just take the same example. So you purchased the vehicle at $50,000. The company should measure the fair value of the vehicle at the end of year one, let's say $45,000. Let's say the company again estimates the fair value of the same vehicle at year two at $35,000. and year 3, 30,000. This is the most precise and realistic way of measuring the depreciation. So in year 1, you're going to report $5,000 of depreciation. In year 2, you're going to report $10,000 of depreciation. In year 3, you're going to report this $5,000 of depreciation. This is the most precise way of reporting the depreciation, but this is not practical. That's the problem. It is very costly and it is not practical to estimate the fair value of every single long-term item, long-term assets the company possesses. So even though this is a very precise measure, in real world, we don't use this approach. And the approach that we use is the accounting method. Which means in overall, we have 3 methods that we're going to cover in terms of accounting. So we have a straight line method. We have double declining method, and we have activity-based method. Okay. So overall, what these 3 methods are doing is basically estimating. This is the key, estimating the depreciation. Okay. Here, we're not estimating. We're actually doing the accurate measure of depreciation, but because of the fact that this is a very costly and impractical process, accounting professional came up with these 3 methods to estimate the depreciation. That's basically the idea. Okay. So this is a graphical illustration of the depreciation. So you have the purchase price of the long-term assets, and that will produce benefits in multi-periods. But at the same time, during that period, the value of that asset decreases, and that's called a depreciation. So the company is going to allocate those depreciations in each period and report it in the income statement as well as in the balance sheet. Okay, and going forward in the next few minutes, we're going to talk about these 3 methods to estimate the depreciation dollar amounts. Okay.
What's the second one after straight line? I just can't read it.
Oh, double declining. Yeah.
Okay, thanks.
I mean, it's in the textbook, but let me just write it clearly. Double declining method.
And what's the logic of that?
So, I mean, for straight line method, it's pretty much straightforward. So let's say in year 1, you depreciate $5,000. In year 2, you depreciate 5,000. So the depreciation dollar amount is basically the same throughout the year. That's the straight line method. For double declining, you're going to depreciate more in the first period. Okay, so let's say you depreciate $15,000 in year 1. You depreciate $13,000 in year 2. So basically, but in the later year, you are only going to depreciate $3,000.
But the logic.
Yeah. So I mean, if it is a new, the value of the asset will decrease more in the first period, but as time progresses, there are not going to be much depreciation in the later years. That's basically the idea for the double declining. For activity-based method, you're going to depreciate based on the real activities that you're using for that asset. We're going to talk about them later on. Okay. Now, before we get into these different types of method, the journal entry is always the key. Okay. So without understanding the method, let's say this debit and credit. So debit of depreciation expenses and credit accumulated depreciation. This is something that you should memorize for the journal entry. Okay. So when you're reporting the depreciation in the debit, you're going to report depreciation expenses. In the credit side, you are going to report this accumulated depreciation. Okay. And that accumulated depreciation is in contra, we talked about this, contra asset account. That brings the dollar value for that asset down. Okay. So let's say, for example, you have a balance sheet here, and you have a plant right here. Let's say this is 50. You have an accumulated depreciation for that plant at 5, for example. So you have a net plant of 45. Okay. So this is an example. Oh, right here. Okay. So you have an original purchase price of the equipment. You do, again, you only report this contra asset account called accumulated depreciation, and then you are going to report the net amount for that particular equipment or plant in this example. You never brings the original purchase price down directly. Okay. Now, some of the terminologies that you should be familiar with is this 3 things. So service life or useful life. So basically these are the estimated use the company expects to receive the asset of. Yeah, basically it's the number of years or the number of time that the company intends to use for that asset. So for example, plants, they could last for 10 years. Okay, for example, vehicles, they usually last 5 years. So these are the service life or useful life for that particular asset. Residual value or the salvage value is basically the amount that the company expects to receive from selling that asset at the end of its service life. So what that means is, let's say this plant after 10 years, the value is expected to be, for example, $3. Okay? So that's the salvage value or the residual value of the plant. Vehicles, of course, when we talk about $50,000 vehicle, after 5 years, maybe the value becomes $20,000. So that's going to be the residual value or the salvage value of the vehicle. Okay. Depreciation method, yes, I talked about this. So straight line method, double declining method, or activity-based method. So basically, we are going to estimate the depreciation dollar amount using different types of method. Okay. Straight line, double declining, activity-based method. Which method is better? There's no way of telling which one is superior to the other, depending on the situation. But most of the cases, companies adopt the straight line method because it's the most straightforward, easy to implement, and it does not have any bias to it. So in reality, literally all of the companies adopt this straight line method. For tax purposes, or not tax, yes, for tax reporting purposes, companies use double declining method because you are reporting higher depreciation expenses in the first period. That means your net income will be reduced because of the higher depreciation expenses. If you report lower net income, that means you're reporting less taxable income, right? So for tax purposes, the company will use double declining, but for accounting reporting purposes, most of the companies use straight line method. Okay. I think this is about time to take a break. Okay, so after taking a break, let's get into different types of method, how to calculate the depreciation in year 1, 2, 3, and 4 going forward. But it gets very complicated. So I think it's about time that we take a break for 20 minutes. So we're gonna come back at 7:45. Okay, so we'll resume at 7:45. Okay, so it's 7:45, so we'll resume our lecture. Just one thing, so some students are sending me emails with their questions on the midterm. So if you're not sure with some of the questions on the midterm, you can definitely send me an email asking for clarifications, okay? I think I got another email. So again, so in preparation for your final exam, I strongly advise you to review the midterm and then, yeah, send me any questions that you may have on the midterm to basically better prepare for the final exam, okay? And then another thing that I forgot to cover, because I was going very fast, is something related to patents. So we talked about in terms of the purchase price in case of the patents, when a company purchases the patents, the dollar amount that you're paying for will be capitalized plus any legal and filing fees. If the innovation is being developed internally within the company, you're only going to capitalize legal and filing fees. These research and development costs are expensed and then reporting the income statement. But there is a case where the company is sued, okay, sued from another company, okay, another company. So let's say company A, company B. So basically company B says, oh, you're infringing my my patents or my technology or my innovation or any lawsuits against my company with related to these patents, there are going to be two possible consequences. One is you succeed in defending the patents, okay? And you're going, sometimes you can lose in defending the validity of my patents, okay? So in case the company succeeds in defending the validity of these patents, those costs, so the cost of hiring or retaining lawyers and attorneys, any legal fees and all these extra costs related to these lawsuits will be added, okay, to the patents, okay? So by succeeding in defending these patents, your value of the patents will increase, and the dollar amount to include that patents is all costs associated with the lawsuits, okay? But in case the company loses in defending the validity of the patents, the cost will be expensed, okay? So this is one scenario where there could be a capitalization of costs when the company succeeds and expensing those costs when the company loses. And I forgot to cover this. So if we go to Apple's 10K financial statement, and I think I highlighted this. So in page 12, they talk about this company. The Apple company could be impacted by unfavorable results of the legal proceedings. So we all know from media reports that Apple company is being sued multiple times from multiple companies. So they say the company or Apple is subject to various legal proceedings and claims against the company based on allegations of patent infringement or other violations of intellectual property rights. The company is vigorously defending infringement actions in court in several US jurisdictions. So this basically Apple is disclosing all these legal proceedings and possible violations and allegations against other companies in their financial disclosures. The outcome of litigation is inherently uncertain. Obviously, we don't know until the judge makes the final formal rulings. So I think they provide some examples. Yeah. So if you go to page 55 of Apple company's 10K, for example, I don't even know how to pronounce this company. So Vernet X company filed lawsuits in the district court of the Eastern District of Texas against Apple, alleging that company product infringed 4 patents. Okay. So this Vernet X is suing Apple company. According to this disclosure in 2016, a jury returned a verdict in Vernet X won against the company, awarded damages of $302 million, which later increased to $440 million in post-trial penalties. So basically, Apple is obligated to pay a total of $440 million to Vernet X. The company or Apple appealed. Obviously, that's a large amount of money. And the verdict is that the penalties increased to $503 million. So we're talking about large amount of money. If the company successfully defends the patents, they will be added to the patents. If the company loses, those costs will be expensed. Okay. Now, Apple, so basically, I mean, this is a slight different context. So basically what's happening here is that, so this Vernet X company sued Apple, okay, for the infringement of the patents, and Apple company lost so far, and they're obligated to pay $503 million. Now, what the Apple is doing is this: the company or Apple has challenged the validity of the patents. So instead of going to the court with respect to this infringement, they are going to another court saying that the patent is just invalid. So the Apple is playing dirty against this Vernet X company. So this PTO, or the Patent and Trademark Office, declared that the Vernet X patents is invalid. So in this case, Vernet X will expense all the legal preceding costs in their income statement because they lost the validity of the patents. Okay. So depending on the outcome, some costs will be capitalized, some other costs will be expensed. Okay, so this is another thing that you should know with respect to the patents and the cost related to defending the patents. Okay, any questions on this?
This has been going on for a couple of years. So when do you expense and capitalize?
You mean so in, let's say, 2016 and 2017?
Right, because I mean, this is still ongoing in 2019, and it started in 2016.
Yeah, so definitely, I don't even know the definite answer to it. My guess is it will be expensed because, again, the outcome of that litigation is inherent. Oh, let me go back. Because the outcome is not certain, there's no way to quantify by what amount you should capitalize the cost. So if it is uncertain, you just have to expense it. And then depending on the outcome, sometimes you will reverse it, or you can just capitalize it depending on the outcome. Okay. Any other questions? I think there's a chat. So Athman asking, are legal fees for victories capitalized since the immediate benefits associated with them are not immediately? I'm not quite following. So since legal fees for victories capitalized since the immediate benefits associated with them are not immediately realized. Kind of like, so again, so the outcome if the outcome is victory or succeeding, you will capitalize it. If the outcome is the loss for the case, you will expense it like an R&D expense. Okay, that's my answer. Yeah, so that's one legal proceedings. So this was the case of Vernet X. Also, Qualcomm also sued the Apple company. Qualcomm said that you should pay me for the infringement, but the Apple company has not been paying for that. So finally, during 2019, the company Qualcomm reached a settlement agreement to dismiss all litigations. If it is a settlement, it is a win for both parties, so you should capitalize it. that's the case. And then there's a French competition authority. So, I mean, the company is subject to all sorts of legal proceedings and court cases. So you should really be not familiar. We should at least understand that the company is it can be a target for illegal proceedings, and you should also know how to account for this transaction, this legal proceeding with respect to the dollar amounts and the patents. Okay. Any other questions related to the legal proceedings? Okay, so we'll leave it that way. And now we're going to talk about different method of depreciation. Okay, let's start with a straight line depreciation. This is the most straightforward and easiest way to estimate the depreciation, okay, for an asset. So it starts with the purchase price of an asset. So given this information, the cost of the new truck is $40,000, and the estimated residual value of an asset is $5,000. Okay, we're not going to use this last information for now. For straight line method, we only care about the purchase price and then the residual value. Okay, residual value. So this amount, purchase price minus the residual value, are the dollar amount subject to the depreciation. Depreciation. Subject to depreciation. Okay. And then the company expects that this asset will be used for 5 years. Okay, so 5 years. So you're going to divide the difference by 5. Service life. Service life. So in terms of the numbers, you have $40,000 minus the residual value, 5,000. You're going to divide that by 5 years. And that will give you $7,000 of depreciation every year for the next 5 years. Very straightforward, right? And easy. So what that means is that in year 1, you are going to record a journal entry, depreciation expenses by 7,000 and accumulated depreciation of 7,000. And year 2, same journal entry will be recorded. Depreciation expenses, 7,000, accumulated depreciation of 7,000. Okay, and you're going to repeat this for 5 years. Okay, so again, depreciable cost, or the amount that are subject to depreciation, is 40 minus 5, so that's 35. Now depreciation rate is basically means 1 over the service life. In this case, it's 5. Okay, so that's 20%. Okay, so in other words, every year you're going to depreciate 20% of the depreciable cost. That's what this depreciation rate indicates. Okay, so every year you are going to depreciate $7,000. Okay, and the journal entry for that straight line depreciation is this. Easy, right? So at the end of year 1, in the balance sheet, what you're going to see is this. So we don't know the asset. Let's say this is asset of $40,000. Okay, this was the purchase price, and then you're going to see accumulated depreciation contra asset account of $7,000. So you have a net asset of $33,000. That's year 1. And year 2, you're going to see similar balance sheet, but with a different account, the dollar amount, asset, same at $40,000. For accumulated depreciation, you're going to see $14,000. Okay, In year 1, you reported 7,000. In year 2, you report additional 7,000. So that totals 14,000. Okay, I forgot to in parentheses. So your net asset equals 26,000. Okay. Easy, right? Any questions on this? Okay, so after making all depreciations.
Wait, sorry. How do you get the depreciation rate? What is that?
So depreciation rate is basically means 1 over the service life. In this case was 5. So every year you are going to depreciate 1 over 5th or 20%.
Great,
That's
thank
what
you.
the depreciation stands for.
Is there a maximum number of years the depreciation can be done over?
I could not hear you clearly. Is there what?
Is there a limit to the number of years that like?
Is there a limit in terms of the number of years? No, no.
Yes.
It's the judgment again. It's the company's judgment. Vehicles usually 5 years. Factories can be 10 years, 15 years. So depending on what the company was originally intended to use for how many years, that will determine the service life. Okay. Any other questions? Okay. So after depreciating this asset for 5 years, you should see the residual value or the book value of the asset equals to the residual value or the salvage value of the asset. Because basically after 5 years, you have depreciated everything for the depreciable cost. So at the end of the year, your remaining dollar amount, or not the dollar amount, the remaining value of that asset will equal to the residual value.
Where do you get the residual value from?
That's usually given here. So after 5 years, the company expects that the value of that truck or vehicle will equal to 5,000. And that's the judgment again.
So that up front, you have an estimate of the
Yeah, yeah.
value. Fine.
Mm-hmm. Any other questions? Okay. I mean, straight line method is pretty much easy. We don't have any problems. So partial year. So, I mean, in reality, companies can purchase assets on January 1st, 2019, January 1st, 2020, but there could be cases where the company buys an asset in March or in April. And given that, how do you calculate the depreciation? I mean, it's pretty much, again, straightforward. So given this example, every year you're going to depreciate $7,000. Let's say the company purchased this vehicle on March 1st. Okay, so that means out of 7,000, you have 10 months to go until the end of the year, because we close the book at the end of the year, which is December 31st. So you're only going to depreciate this $5,833 instead of 7,000, because the date of the transaction was on March 1st. But during years 2 to 5, you're going to depreciate $7,000 each, because you're taking this full year to account for the depreciation. And at the end and during year 6, okay, these 2 months, this January and February, will be remaining basically. So in year 6, you're going to take this 2 out of 12 to account for the remaining depreciation, which is equals to $1,167. But again, at the end of the depreciation, your total depreciation should equal to this depreciable cost. Okay. But yeah, as long as you make sure the date of the transaction is, as long as you make sure the date is confirmed, and then make the respective ratio of 10 over 12, the calculation should not be that difficult. Okay. So how much depreciation should be recorded in the first year for a delivered truck purchased on April 1st with a cost of $30,000, an expected life of 5 years, and estimated residual value of $5,000? Assume the straight line method is used. So this is pretty much easy. So purchase price is $30,000. Residual value is $5,000. Okay? So your depreciable cost is $25,000. You are going to depreciate over 5 years. So that means you're going to depreciate $5,000, okay, each year. But the problem is the vehicle was purchased on April 1st. So 3 months has elapsed already. So the remaining number of months is 9 months only out of 12. So you're going to multiply that with 9 over 12. So that will equal to 3,750. Okay. Just one thing that you should be careful during the exam. Okay, so straight line method is pretty much easy, nothing fancy, nothing complicated, but it gets more complicated when we do the double declining method. What are we doing here? Oh, so before we get into double declining method, there could be other cases where there are some changes with respect to the depreciation. So here, assume that after 3 years, remember we had 5 years to depreciate. After 3 years, the company estimates the remaining service life of this truck to be 4 more years. Okay, so the service life for that truck has been extended by a few more years. So for a total service life of 7 years rather than 5 years. The company also changes the estimated residual value to 3,000. So if you are using more vehicles, and if you're using this vehicle for a longer period, your residual value will definitely reduce, right? It was originally $5,000. If you're using 2 more years, that means the residual value will also decrease. So it's now $3,000. Now, given this change, how much depreciation you are going to record from years 3, 4, 7? That's the question. Now, the best way to deal with the change in these estimates is to treat it as a new vehicle purchased with an updated information. So what that means is that, so you originally had $40,000 of purchase price, you had a residual value of 5,000, and your service life was 5 years. Okay, this was the original information that we used. So in year 1, okay, in year 1, we depreciated 7,000. Yeah, 7,000. So what that means, your book value of the vehicle becomes 33,000. Okay. In year 2, you depreciate another 7,000. So your book value now becomes 26,000. And year 3, you depreciate another 7,000. So your book value now becomes 19,000. Okay. So at the end of year 3, there are changes to the estimates. Now the residual value is 3,000, and your service life, it says 5 years, but it says 7 years right here. Where does it say? It says 7 years, but 3 years has already been elapsed. So what that means, the remaining is 4 years. Okay, so we're going to start from this 19,000 with residual value of 3,000 and 4 years to go. So treat this as a new vehicle purchased rather than continuing with the old vehicle. That's the easiest and the best way to tackle these types of questions. Okay, so you have a new vehicle. It's a per se, like a new vehicle of 19,000 with residual value of 3,000 and 4 years to go. So that means your new depreciation expenses should be 19,000 minus 3,000 divided by 4. So that's $4,000. So in year 4, you're going to depreciate 4,000. In year 5, you're going to depreciate another 4,000. Okay, that's how you account for the changes in the depreciation estimates, and that's $4,000 is the amount that you're going to report under depreciation expenses. Okay, so again, whenever there are some changes with respect to the estimates on the depreciation, you are going to treat it as a new vehicle purchased, but with the carrying or book value of the vehicle, with the new updated residual value and the number of years. Yeah. Any questions on this? No questions. That's good. Okay. So that was the straight line method. Let's get into double declining method. So straight line method basically means you're going to depreciate by the same amount at every year. But for double declining method, you are going to depreciate more in the first few years, and you're going to depreciate less in the later years. As you can see right here, in year 1, you depreciated $16,000. In year 2, you're going to depreciate $9,600, much less than the first year, and you're going to see more lesser amount of depreciation expenses as time passes. And the question is, how do you get this number? How do you come up with these numbers? So again, the information given is the purchase price is $40,000. Residual value is $5,000. Service life was 5 years. These 3 are the information given upfront. Now for double declining method, you don't care about the residual value. This is one important thing. You don't care about the residual value, okay? You only care about these 2. So here we talked about this depreciation rate previously. It was for straight line method, it was 1/5. So 1 is given, 5 is the service life years. For double decline method, you're going to use 2 because it is double, right? So 2 over the service life, which is 5. Okay, that's the depreciation rate that you're going to use. Right, 2 over the service life, so that's 0.4. That's what you see right here. So what you're going to do in year 1, okay, is that you're going to take the entire 40,000. Again, you don't use this residual value. Multiply that by the depreciation rate, 2/5. Okay, so that's 16,000. That's how much you're going to depreciate in year 1. Now, by depreciating 16,000, your book value of the asset now becomes 34. Oh, is it 34? 24. Stupid. 24,000. Okay. Now, in year 2, you're going to take this book value of the asset at the end of year 1. So that's 24 times the same depreciation rate. Okay. That's 96,000. Oh, 9,600. What am I doing? Okay. So at the end of year 2, your book value of the asset now becomes 14,400. Okay. Now at the end of year 3, you're going to take the book value of last year, 14,400, multiply that with the same depreciation rate, and that's 5,760. Okay. Now I'm doing everything for you because there are some comments that I want to make. So at the end of year 3, you have a book value of the vehicle at 8640. My handwriting is bad. 8640. Year 4, your new depreciation expenses becomes 3456. So your book value of the vehicle now becomes 5184. Okay, that's year 4. Now year 5, it gets very tricky. let me just do the math. So you have a book value of the vehicle, 5184 times 2/5. That's, let me use the calculator. 5184 times 2/4. I made a mistake. 5184 times 2/5. Okay, so that's 2073.6. So now your book value equals 5184. 5184 minus 2073.6 becomes 3110.4. Now, remember the residual value should be 5,000. What you just got out of this calculation is much less than 5,000. Okay, so what that means, you over depreciated the asset, which is not right. Okay, this is wrong. You cannot go below the residual value, because basically at the end of the year or at the end of the service life, this $5,000 is what you're expected to collect by selling that asset. So you cannot go beyond, or you cannot go below this 5,000. So in this case, what you're going to do is to scrape all this, okay? Scrape everything, and you're only going to depreciate this $184, okay? And to make the value of the asset at 5,000. Okay. So for double decline method, there is a high probability that in the last few years, you are going to over depreciate below the residual value. In this case, you are only going to take the right, I call it the right amount to depreciate to match the residual value that equals to the depreciation amount. Okay. Any questions on this? Oh, okay. So this is the thing that you should be really careful. In the first few years, there's no problem with double declining method with respect to depreciations, but in the later years, there is a high probability that you over depreciate the asset. And if you ever finds out that you're actually over depreciating the asset, you're going to make some edits and corrections to the depreciating expenses to make the book value of the asset equal to the residual value. That's the one thing that you should be really careful in the real life as well as in the exam. Okay. So we don't have any questions on double declining. So I think they're going to talk about the over depreciation. So do not make that mistake. Concept check. So how much depreciation should be recorded in the first year for a delivered truck with the cost of $30,000, unexpected life of 6 years, and residual value of 6,000 using double declining method? So for double declining method, again, you're not going to worry about the residual value. You're going to take the entire 30,000, multiply that with 2 over the service life, which is 6. Okay, so that's $10,000. That's the depreciation that you are going to report in the first year. And for year 2, if I'm going further, you depreciated $10,000, so your book value becomes 20,000. So you're going to multiply that with 2 over 6. That's $6,666 depreciation for year 2. Okay. So that was double declining method. Let's go to activity-based depreciation. So same information, it's just instead of for straight line method and double decline method, we use the service life in order to calculate the depreciation for every year. For activity-based method, we're going to use the estimated activity that the asset will be used. So if we're talking about trucks, let's say the company expects that the truck will be driven for 100,000 miles during their service life. So what we are going to do is to take this purchase price and then subtract it with the residual value to get the depreciable cost and divide it by the expected activity life or activities. Okay, so what we are getting here is 0.35 per mile. So every mile that the truck is driven, the depreciation will be calculated by multiplying 0.35 multiplied with the number of miles driven in each year. Okay. So the rate is 0.35. Let's say in year one, the company drives 30,000 miles. So you're going to take 30,000 miles times the 0.35 to get the depreciation expense of 10,500. Okay. And let's say in year two, the company drives 22,000 miles in total. You're going to multiply that with the same rate, 0.35. So you're going to get the depreciation expenses of 10,700. Okay. So again, basically these are the estimates that the company uses to report the depreciation expenses. 3 different methods: straight line method, double declining method, and activity-based method. You should be really familiar with these 3 types of method, and then the journal entries that you report in each year. And then in case of the double declining method, be careful with over depreciating in later years. There's a high possibility that you over depreciated in year 5 in this example. Okay. So, but at the end of the day, the total depreciation dollar amount should be equal to whichever method that you're using. It's just the depreciation dollar amounts in each year that differs depending on which method you're using. Okay. So for straight line method, the dollar amount for the depreciation expenses are the same throughout the year. For double declining method, you have the highest depreciation expenses in the first year, and then the amount will decrease as you go forward. For activity-based method, it depends on how many miles in this example, how many miles you drive in each year, that will determine the depreciation expenses. Okay. This is just a graph again. So for straight line method, it stays the same, $7,000 every year. Double declining method, you have the highest reported depreciation expenses and lowest in the later year. Activity-based method, depending on the miles. Okay, it changes all the time. So that was the depreciation with respect to the physical tangible assets. For intangible assets, we call it amortization. So that's basically, the idea is the same. The value of the intangible assets will sometimes decreases. Sometimes decreases due to various reasons. Okay, it's just the name or the terminology that we use are different. For physical tangible assets, we say depreciation. For intangible assets, we say amortization. Okay, so I don't know how many of you have taken out an educational loan, but if you ever request an amortization table for your educational loan, it will show you the amount of interest expenses that are accrued throughout the year and how much of the value of the loan will decrease as years pass. But the table of the interest and then the educational loan amount is called an amortization table because the loan itself, it's not tangible. So it's intangible, so it's called an amortization table. Okay. So tangible, depreciation, intangible, amortization. Most intangible assets have finite useful life. So, I mean, we talked about copyrights having 70 years of service life. We talked about patents. Patents have 5 years of useful lives. So under the contract, it will specify how many years it will be useful and then protected from the infringement. So for intangible assets, we also have a finite useful life. Most companies use straight line amortization. So straight line is very easy. So the journal entry with respect to the amortization, similar to depreciation, but instead we use amortization expenses right here, okay? Now for tangible assets, we use accumulated depreciation, right? We use the contra asset account to bring the value down for the asset. For amortizations, we directly reduce the value of that asset. So instead of recording let's say accumulated franchises, we just directly reduce the value of the franchises by $40,000 in this case. Okay. So in this example, the value of the franchise was $800,000. The agreement is for 20 years. So under the straight line method, the company will amortize the franchises for $40,000. So that's the amount that the company reports related to amortization. Okay, any questions on this? Okay, so same idea goes here. So the company purchased the patent for $72,000. The legal life, in this case, it gets a little bit tricky. So under the contract, so originally the patent has 20 years of legal life, but at the point of the purchase, the remaining years were 12 years. So 8 years has already been elapsed. So the 12 years are remaining. But because of the technology and because of the advanced in innovations, it is only viable for only 8 years. So you are given 2 years here. So 2 types of years. So you have legal life of 12 years. And here you have an economic life or useful life of 8 years. In this case, you are going to only use this 8 years and when calculating the amortization. Okay. So even though the legal protection is given for 12 years, beyond 8 years, it just becomes useless because of the technological advances and innovations. So in this case, you're going to use this 8 years of useful economic life to come up with the amortization dollar amount. Okay, but the idea is the same. You're going to debit amortization expense of $9,000 and directly reduce the patents by $9,000. Any questions on this? Brooke says, if the legal life was 7, would we use that? Of course. I mean, if the legal life in 7 years and economic life is 8 years, you're only entitled to 7 years. So in that case, you're going to use 7 years. Okay. Any other questions? Okay. So in terms of the amortization, these patents, copyrights, trademarks, and franchises, they have a finite useful life. Patents usually 20 years, copyright 70 years, trademarks and franchises, depending on the contract, it has a finite number of useful life. Again, goodwill, you don't have the useful life. It just goes on and on unless the company goes bankrupt, right? So in this case, you don't amortize, okay? So amortization, depreciation only applies for assets that have a finite number of useful life, okay? That's the key here. Again, I don't really care about this different types of or definitions or different types of intangible assets. As long as you know how to calculate the amortization dollar amounts and journal entries, you're good. Rob asking, do you essentially always use straight line? Yes. So for amortization, you use the straight line method. I have never seen any companies that use different method other than straight line method when it comes to amortization. Okay. I mean, when we're talking about patents, trademark and franchises, yeah, I mean, straight line method is the most direct way of amortizing the assets, right? Any other questions? Okay, so, ooh, time really flies. So we talked about acquisition, okay? Which cost to include, which cost not to include. We talked about depreciation, okay? And finally, we're going to talk about gain or loss on sale of the asset. Okay, so you purchased it, you depreciated. Now we are going to sell it to another party. Okay. So in terms of the disposal, there are three ways to dispose an asset. You can sell it to another party, you can retire it, or you can just throw it away. It is because it is just useless. Or you can exchange it with an updated or upgraded or something new. There could be an exchange. So let's talk about different types of transactions with relate to the disposal of long-term assets. So sale is the most common way of disposing long-term assets. So at the end of the service life for trucks, for example, you can just sell it off to another party as a used car, for example, used car. Retirement, if it just goes wreck or yeah, I mean, you know the idea. You get the idea. You just throw it away. Exchange, you can basically exchange with a new vehicle. So in the real world, there's a trade-in. Okay, so for the trade-in, you can make an exchange, an old phone with a new phone, for example. Okay, so same idea. So let's talk about the cases where the company sells after 3 years this truck for $22,000, or the case where the company sells the truck after 3 years for $17,000. So let's take each case separately. So basically the idea is this. So year one, you're going to depreciate $7,000. So your book value of the truck becomes $33,000. Year two, you depreciate another $7,000. Your book value now becomes $26,000 after 3 years. So year three, you depreciate additional $7,000. Your book value now becomes $19,000. Okay, so your book value of the truck at the end of year three is $19,000. And then in this case, the company sells that truck for $22,000. So the value is 19, but your selling price is 22. So there is a gain on the sale. Okay, so in terms of the journal entry, there are four things. Okay, let me just write it here to make it easier. So when you're disposing your asset, you're going to credit it, right? You're going to reduce that asset. And this is where you should be very careful. So you're going to credit truck. Oh my God, my spell. Truck, the original price was 40,000. Okay. And your accumulated depreciation was the sum of these three, 21. So your net asset or net truck becomes 19, as you can see right here. Okay. Now you're selling the vehicle for 22. So what that means, you're receiving cash of 22,000. Now these two doesn't balance. So the debit side is 43. Your credit side is 40. So there is a gain on sale, which is 3,000. Okay. So this is the journal entry for that transaction. But intuitively, this is, I mean, easy, right? So your value of the truck is 19. You're selling it at 22. So there's a gain of $3,000 on the sale of the truck. Okay, so that's
why is a gain a credit on an asset account?
This is similar to revenue. So when we report revenues, we credit, right?
Oh, it's a revenue. Okay.
Yeah. Well, not technical revenue, but like similar to revenue, right? It's a gain. It's like making money out of it. So you credit.
All right.
Okay.
But Professor, didn't we have to remove the residual value first, like 40,000 minus 5?
No.
And because is this a straight line?
Yeah, this is a straight line. But it doesn't matter with the straight line or double declining. So the value of the truck is $40,000. Okay. Residual value 5,000 is the value at the end of 5 years. But we're talking about in the middle of 5 years. We're talking about after 3 years. So you don't care about the residual value.
Okay, thank you.
Mm-hmm. Any other questions? So let's talk about, so Yana is asking where and how the gain is reported. So gain is reported similar to revenue income statement. I don't know whether Tesla has the gain. Let's take a look at operations. So nope, Tesla does not sell any assets. Let's look at, I don't know whether Apple has that, but it is again reported in the income statement. Yeah, I don't see it right here, but this is an income statement item. Okay. Let me go back. So that was the first case. Now imagine the case where the company sells the truck at 17,000. So now the value is 19, but the company is selling at 17. Let's see what happens then. So you have another debit, debit, credit, credit. Truck originally 40,000. Okay. Accumulated depreciation is 21,000. Okay. Now the company is receiving cash, but the amount is only 17,000. Okay. So on the debit side, you have 38. Okay. 38. On the credit side, you have 40. So you're going to have another debit, which is loss by 2,000. Let me just make it more clear. Okay. Now you have 3 debits and 1 credit. But the idea is simple. You have $19,000 value of truck right here, and the company is receiving cash for 17,000, and these two does not balance. There's a difference of $2,000, and on the debit side, you're going to report a loss on sale. Okay. But again, this is very intuitive. The value of the truck is 19, but you're only receiving 17. So there's a $2,000 loss on the sale. Okay. Any other questions? Okay, so this was it. Basically same idea. You're receiving cash 22. This 19,000 is the net of the truck, and there's a $3,000 gain. Okay. In case of the sale by 17, okay, you're reporting a cash of 17, accumulated depreciation and truck of 19,000. Also, you're reporting a loss on the debit side by 2,000. Same idea here. Okay. Now, in terms of the retirement, okay, so go up. Okay, comes so slow. Anyways, the idea is very simple. So you have original $40,000 of truck. You have accumulated the depreciation for a total of 21. There is no cash receipt on the sale because you're just retiring it. So the entire the remaining $19,000 will go to the loss because you're not getting any cash out of it. Okay. And yeah, questions?
If you determine that the life of it would result in a 0 value at the end of it, you wouldn't have to do this, correct?
Yeah, I mean, at the end of the service life, the loss amount will equal to the residual value, basically. Any other questions? Okay, so that was the case of retirement. Do we have an exchange? Yes. I'll correct this. I cannot read the fonts here. In case of the exchange, so let me just go back to, okay. So there's a case when the company exchanges for a new truck that worth $45,000 and you also pay $22,000 cash. Okay, so let me just draw debit, accumulated depreciation. We have accumulated 21,000. We're going to sell off truck. Let me just indicate an old vehicle of 40,000. Okay. Now, when there is an exchange, you're going to debit another truck. Okay. But this is a new truck that worth 45,000. Okay. Also, at the same time, you're paying 22 cash for that exchange. So when you pay cash, you're going to credit cash by 22,000. And the question is, do they balance? Do they equal to each other? So on the debit side, you have 66K. On the credit side, you have 62K. So $4,000 difference. And you have to report credit something $4,000 to make it balanced. And whenever there is a credit remaining balance, it is going to be a gain. Okay. This is the journal entry that you're going to report for that exchange. Oh. Okay. So let me just go to that journal entry. So this is an old truck, accumulated depreciation, 4021. You are gaining a new truck worth 45,000, and you're also paying cash of 22,000. If they balance, okay, if they balance, you don't have to report a gain. But since there is an imbalance between debit and credit, you're either going to report a gain or loss, depending on the difference. In this case, you're going to report a gain on the exchange, and the amount is $4,000.
I'm sorry, explain the gain again, I'm sorry.
Explain the, so basically, oh my God. Let me, so on the debit side right here, the total of the debit is $66,000, right? On the credit side, you have $62,000. So they don't balance. Okay, you have to add additional line item to balance the debit and credits. So this 4,000 difference, you have to add additional $4,000 on the credit side to balance the debits and credits.
Well, I was thinking more like, are you getting gain on your trade-in value is greater than your book value? Is that what that is?
Yeah.
Okay, so where's that?
That's the gain here, right here.
Yeah, no, I got it. Okay.
Mm-hmm.
Fine.
So all depends on the value of the new asset and by how much cash that you're paying for that exchange. There could be a gain on exchange or there could be a loss on exchange. Okay. But again, that depends on which side is greater than the other side. Okay. Any questions on this exchange? For some reason, my pen is not working. Whoa. Pen mode. Okay. Anyways, I'll try. So this was pretty much the chapter 7 that I wanted to cover. But I want to talk about some. So in the beginning of the semester, I talked about the fact that I'm not going to really care about the ratio analysis. But for these ratios, I think they are very important in terms of understanding the financial statement. So I decided to cover them a little bit. So in large, there is one ratio called return on assets. There's another ratio called profit margin. I don't really care about the asset turnover for these two. So return on assets, sometimes companies call it, let me just use Word. Okay. Sometimes call it ROA. Okay. Make it bigger. Okay, so return on assets. So that basically means using your assets, how much revenue are you making? That's basically what ROA stands for. For profit margins, basically that means out of all the revenues, how much are you making after subtracting the cost of goods sold? That's basically what the profit margin stands for. So here, we have Walmart and we have Costco. And let's talk about which company is more profitable. I mean, we can just compare the raw net sales to compare the profitability of the company. So Walmart is making sales of $481,000. I'm sure it's millions, so it's a lot more larger. But just give it an easy way. So 481,000 for Walmart. Costco is making 129, so definitely Walmart is larger. Does that mean Walmart is more profitable? Not necessarily. Also, we talk about net income in the income statement. Here, Walmart has 14,000. Costco has 2,000. Does that mean Walmart is more profitable relative to Costco? Depending on the situation, depending on which indicator that you want to use to analyze two companies. So here, return on assets. Basically, return on assets, the formula is net income divided by the average total assets. So what that means is that using your assets, how much net income you're producing in each year. That's basically the idea. How much return you're making out of using your assets. So here in this example, you have the beginning asset, ending assets. So you're going to take the average of these two assets and then use the net income to calculate the ROA. So here you are taking the average of assets and you are going to use the net income to calculate the return on assets for Walmart as well as for Costco. Okay. At the end of the day, Walmart has 7.2% of return on assets. Costco has 7.7% for return on assets. So even though the raw dollar amount for net income is way much higher for Walmart, ROA is higher for Costco. So what that means, even though Walmart may be making much larger dollar amounts every year, in terms of the efficiency of the company, in terms of the effectiveness, efficiency is the right term. So efficiency of the assets producing or generating the net income or revenues, it's much higher for Costco instead of the Walmart. Okay, so depending on the situation, are you going to talk when analyzing the financial statements between companies? Are you going to focus more on the raw dollar amounts to compare the companies, or are you going to compare based on the efficiency and effectiveness of the operation to compare the companies? So depending on the goal of your analysis, there could be different indicators that you're going to use in the comparison. Okay, so that's ROA, very important indicator used in the real world. Also profit margin here. So your net income is 14,000, but your total revenue is 481,000. So out of total sales, how much are you actually making in a year after subtracting all these expenses and losses and interest payment? Your Walmart is profit margin of 3%, Costco has 2.1%. So in this case, Walmart is more effective in generating the profit margin out of the total sales. Okay, so again, depending on which indicator you're using, your analysis can also change basically. Okay, but I think profit margin and ROAs are very important indicators when analysts basically analyze companies in their financial statement. Okay. Another thing, yes. So this is the last part that I wanted to cover for chapter 7. I wish that I could write something, but I can do it. So remember chapter 6, when we talk about inventory, we talked about law of cost or market. Okay. So at the end of the year, we take the fair value of the inventory and then we compare that to the book value that's reported in the balance sheet. If the fair value of the inventory was lower, we reduced the value of the inventory. That was one of the part in chapter 6 we covered, because basically the fair value of the inventory was lower than what we reported in the balance sheet. Same idea goes here. We're going to compare the value of an asset, long-term assets, and compare that to the book value. And if the value of the asset is lower than what we report in the book value, we're going to report an impairment for that asset. Okay. Now, for inventory, it was pretty much straightforward. We're compare the fair value and then the book value. That was an easy step for inventory. But for long-term assets, it's a two-step process. So for inventory, it was one step. For long-term assets, it's a two-step process. So for long-term assets, we don't use the fair value. We use the future cash flows. So for example, when we talk about machines, we're going to estimate the total cash inflows that this machine will generate during the service life. Okay, that's the first step. In the first step, when we compare the total cash flows during the service life is less than the book value, okay, that means the asset is impaired. That means the value of the machine or value of the asset is impaired because, again, it's similar to the inventory. The value of the asset is lower than the book value. That means we have to impair that asset. If it is if it is higher than the book value, that means asset is not impaired. Okay. So if it is yes, we're going to go to step 2. Then we are going to report an impairment loss. But in this case, we are going to compare the fair value of an asset to the book value. The difference is, in the second phase, you're going to compare the fair value of an asset to the book value. In the first phase or in the first stage, you're going to compare the cash flows to the book value. That's the difference. Okay. The easiest way is to give you an example here. So this trademark is the estimated future cash flow is $20,000. Book value is 50. Fair value is 12. Okay. So in the first step, you're going to determine whether the asset is impaired. So future cash flow is 20. Book value is 50. So that means your future cash flow is much lower than what you report in the balance sheet. So that means it is impaired. Okay. That's the first step. And the next step, you are going to determine the dollar amount of the impairment. In that step, you're going to compare the book value with the fair value here. So book value is 50, fair value is 12. So the difference is 38. So for that impairment loss, you're going to debit impairment loss of 38,000, and you're going to also directly reduce that impaired asset. In this case, it's trademarks, 38,000. Okay. So for the impairment loss, it is very important that you distinguish between the future cash flows and the fair value, and in which step you're going to use, and which cash flows you're going to use. I lost my word. So in the first step, again, you're going to use the future cash flows, compare that to the book value. In the second step, you are going to compare the book value with the fair value and determine the amount of the impairment loss. That's the process. Okay. Any questions on this? Okay. Another thing that I wanted to talk about is, so practice, I'm going to go talk about that later on. So even though in the first stage, you determine that the asset is impaired, in the second step, there are cases where you don't report any impairment loss. For example, here, let's say the fair value is 55. Okay, so in the first step, you say there the asset is impaired because your future cash flow is lower than the book value. In case where the fair value is, for example, 55,000 and the book value is 50, that means your book value is lower than the fair value. In that case, you don't report the impairment loss, even though in the first stage you determine that there is an impairment loss. Okay, but that depends on the fair value of the asset. Okay. Any questions on the impairment loss?
The loss is an income statement item, right?
Yeah.
Okay. It should be thought of as an expense or no?
Yeah, I mean, loss is similar to expenses. So it reduces the net income, it reduces the revenue. So that's kind of related to expenses.
So,
but this is a non-operating line item.
It's a non-operating loss.
Mm.
I understand. And then the trademark is a reduction in asset.
Yeah.
Okay.
Okay. Any other questions? Okay. An impairment loss is recorded when book value. So in the first step, when book value is greater than estimated future cash flow, this is the first step. When book value is larger than or greater than the future cash flow, there is an impairment loss. Right? I wish I could do this, but my pen is not working for some reason. Let me just try again. Yeah, I'll fix them. I can. So I'll cover this practice set in the next lecture. But is there any other questions before we move on to the extra credit presentation? Okay, so I'll close up today's lecture at this point.